U.S. headline consumer prices rose 3.4% year-on-year in July, declining from the high 4.2% in May and then 3.5% in June. Core consumer prices also softened. And one more thing is retail sales drop a small 0.1% month-on-month. It's the first decline in 9 years. And it's due to the fading tax refund boost. So with this, along with the drop of consumer prices, markets decreased the probability of Fed interest rate hike to around 40% during their next meeting on 15th to 16th September. This latest report illustrates how quickly inflation could ease once Middle East pressure fades, but remaining sensitive to energy swings. For equities, stock indexes traded higher because of the eased rate hike concerns and led by technology, semiconductor, and AI-related industries, and also consumer services. For bonds, U.S. Treasury yield fell as rate hike probabilities dropped, and so hence, the clearer interest rate outlook boosted investors' confidence in both government and corporate bonds. Lastly, the dollar index dropped a little as money market prefers higher interest rates. European Central Bank is expected to deliver a final 0.25% interest rate hike. The key thing now is July inflation rose 2.9% year-on-year. It was 2.3% in May and 2.5% in June. It's been picking up due to higher energy costs from the Middle East conflict. The European Central Bank delivered a hike in June and paused in July. They might likely increase one last time in the next meeting. Some background is the Middle East conflict has dragged on for 6 months and driven oil prices to around 25% above pre-war levels. You can see the trend at the right. The high energy cost is pushing consumer prices upwards and risks inflation going into goods and services. And one more thing is the Eurozone economy has shown sufficient resilience to absorb one more policy tightening step. For equities, financial and banks industries will benefit after the interest rate hike, as they can then charge higher rates on loans. You can see the pickup at Euro Stoxx Banks Index. The trend is at the right. Now for the negative ones, real estate and highly leveraged sectors, because with higher borrowing costs, corporate expansion and debt servicing will be more expensive. For European government bonds, it's largely going to be negative. When the rate hikes, prices of older bonds with lower interest rates will be pushed downwards because they'll then be less attractive. For currency with higher interest rates, foreign capital seeking higher yields will tend to be attracted there. But this might be limited if the economy growth isn't strong enough. China is benefiting with the high fuel costs in its electric trucks exports. July's new energy vehicle exports rose 150% year-on-year, and the EV total export value is at $10.8 billion now, much higher than June and May. But domestic vehicle sales dropped 23.6% year-on-year. So this really shows that the strong external demand helps exports growth and outweighs the weak domestic demand. Some background is electric trucks are now much cheaper to operate, and Chinese automakers possess established supply chain advantages which allow them to produce vehicles much quicker and export it overseas. The weak domestic sales are also pushing China manufacturers to aggressively pivot towards the export market. For equities, strong exports demand ultimately boost profits for vehicle manufacturers and battery suppliers. For the opposite, oil and traditional logistics companies tend to suffer a dip as the market moves more towards electric and new energy. For government bonds, the strong export growth is sustaining overall confidence levels. For corporate bonds, rising foreign revenues will lower financial stress. This helps in improving investors' confidence. Lastly, currency will gain higher demand as foreign buyers transact in China. Japan might react and act more for yen intervention and accelerate rate hikes. And joint intervention with U.S. remains the active option at any time. Some background is in July, with a heavy currency intervention and joint efforts with the U.S., both buying yen in the market. It pushed yen from the 40-year low to around 155 against U.S. dollars. However, the yen quickly reversed course, trading back to lower levels. You can see the trend at the right. The main reason for this persistent weak yen is driven by the large interest rate gap between Japan and higher-yielding geographies like U.S. For example, the 10-year yield in Japan is about 2.89%, and the 10-year yield in U.S. is about 4.7%. Investors benefit from selling yen and buying U.S. dollars. So with the yen being very weak, this causes import costs to increase a lot and pushes domestic inflation levels higher. Next, the next Bank of Japan meeting is in September, and markets are expecting the 80% chance of interest rate hike. The weak yen will make export automakers and electronics companies benefit as they earn in overseas currencies and converts back to Japanese yen. But for domestic players, they'll face higher import costs, such as for fuel and raw material costs. Both government and corporate bonds tend to be negative. Much like Eurozone, when interest rate hikes, older government bonds with lower interest rates will lose their attractiveness. For corporate, higher interest rates will push borrowing costs higher. This makes debt servicing more challenging. You can see the S&P Japan Corporate Bond Index at the right is losing some steam. And lastly, for currency, it really depends on the interest rate gap between Japan and the higher yield geographies. On August 11th, Singapore's Ministry of Trade and Industry raised this year's full-year GDP growth forecast to around 4.5% to 5.5%. It's a huge jump from the previous forecast of 2% to 4%. This year's quarter two economy expanded 5.9% year-on-year. That's a strong figure given that last year's quarter 4 came in 5.7%, and quarter one this year came in 6%. All are high figures. The sustained demand for AI, hardware, data center infrastructure is boosting technology and semiconductor export performance in Singapore. And the economic drag from Middle East conflict appears to be less severe than what government officials initially anticipated. And the global economy in first half of this year tends to be resilient, hence supporting Singapore. The next thing is Singapore will continue to be vulnerable to U.S. tariffs. The current 12.5% tariffs is not expected to materially hurt Singapore, but any further increase could weaken business confidence and exports. For equities, the stronger economic growth improves, overall as a whole, companies' revenues and earnings outlook. You can see the trend at the right. For bonds in general, higher inflation, which is what Singapore is facing, will make fixed bond coupon payments worth less. Lastly, the stronger than expected growth makes Singapore assets more attractive, hence supporting the Sing dollar. And because Singapore imports almost everything that it consumes, if the Sing dollar's strength continues to rise, that will eventually push inflation downwards naturally, which is a very good thing. Linking today's topics to the market to see global trends and not serving as a buying guide. For the first one with the highest gain is AEM Holdings. It's benefiting from sustained demand for AI and related industry products. The company is the clearest direct beneficiary. Its first half net profit jumped around tenfold, now at 30.8 million Singapore dollars. Second, Micron Technology. Easing rate hike concerns helped equities, especially in tech and semiconductor and AI-related industries. Micron is also benefiting from the extreme demand for high-bandwidth memory. It also disclosed the $22 billion of customer commitments for memory supply. Third, Fujikura is also benefiting from AI and related spending, but in fiber optic products. Lastly, Sino Truck. Chinese manufacturers are benefiting from heavy e-truck exports as it more than doubled after Iran conflict drove diesel prices higher.